Hello everyone and a warm welcome to our monthly discussion on the fixed income markets. Joining us today is Mr. Mahendra Jaju, Chief Investment Officer, Fixed Income at Mirae Asset Mutual Fund. He'll be sharing insights on the global backdrop, India's macro outlook, RBI's stance and what this all means for investors in the fixed income mutual funds. Welcome sir.
Thank you.
So my first question being that, how are fixed income markets placed at this important juncture, and how with respect to the yields movements, what is the backdrop on the fixed income market on the global side that you could share with us?
So we saw Fed cut interest rates by 25 basis points earlier this month, and that cut came after a long gap. However, in spite of the rate cut, the market yields went up on the long bonds. Now this rate cut is there in spite of the projection by Fed of a higher inflation going forward, higher GDP growth going forward and a lower than current unemployment rate, and Fed said that it's sort of an insurance rate cut. So on that front I think market is therefore not convinced of a sustaining momentum on the rate cut side. At the same time, because of the concerns on inflation and fiscal deficit, generally speaking in the developed markets, investors are asking for higher compensation for the longer bonds, and therefore we saw the long-term rates hit 25-year high in Japan, UK and in France. So I think there is a general trend right now globally where the central banks are likely to cut rates further. However, the yield curves are going to get steeper and therefore one has to be a little circumspect towards the long end of the curve.
Right, so this being on global, now coming to the Indian economy part, with growth being stable and inflation still being under the requisite range, what's your outlook on the domestic Indian economy and especially on the fixed income market with respect to this?
So it's such a stark contrast with what's happening in the developed market. So today's RBI monetary policy review indicated a significant downward revision in the inflation forecast, and the growth forecast was revised upwards, and India's macro fundamentals look so strong. So there is a very compelling case purely based on domestic factors to cut rates further, and I think the governor also mentioned that the space has opened up for rate cuts going forward. However, the long end yields still again remain largely range bound, and that's the trend which it is carrying over from the global trends, as I said, because there is a difference between the US yields and the Indian yields which has narrowed significantly, and since there the tendency for the yields are to remain on the higher side at this point, given the global uncertainties, especially in relation to tariff, there is no, I think, momentum on the long term rates to come down. So I think the same story will play out in India also. We expect the long term rates to remain stable. Maybe it will come down marginally if there are more rate cuts, but then most of the impact of the current liquidity measures as also the further rate cuts will be felt at the shorter end of the curve.
Right, you mentioned on the RBI's MPC policy which happened on 1st of October 2025. So what's your assessment of that? Was the pause the right thing to do as per RBI? And also what about the yield curve, especially on the short end and the long end of that side? How will it could be placed going forward?
No, I think RBI has delivered a very, very sound and sensible policy, because as I mentioned, domestically there is a very compelling case for incremental rate cuts, but there are significant uncertainties for India on the global front, and since the last policy the global space has become more complicated. We saw for the first time US increased the H1 visa fee where Indians are the biggest beneficiaries, so that was a soft first time attack on the services sector, and therefore I think the challenges on the policy front in terms of the global trade for India has only got more complicated, and to that extent at a time when the global bond yields are inching higher, that the difference between our yields and the global yields have narrowed significantly. The balance of payment situation is just about balanced. It's a very sensible thing to have a stable long term rate markets without any disruption, and therefore I think that in line with the policy guidance said and unsaid, I think we expect the yield curve to get steeper, which means the transmission of the rate cuts via liquidity measures into the shorter end is going to be the policy priority. And for the long term rates, I think there will be a wait and watch policy, and further action will come if there is a trend in the global market for the long term rates to come down.
Sure. So with all this in the backdrop, happening with all of this, what or which funds are positioned the best for the investors in this point in time, as per you?
Yeah, I think that should be, intuitively very clear. I think it has to be at the far end of the money market curve. So we have low duration category, we have the money market category, and to some extent maybe short duration category, because it has 1 to 3 or to some extent 5-year corporate bonds where the spreads are still reasonably good, with liquidity improving, trade prospects stabilizing. There could be some traction there, but largely I think at this point, in one line, I think it is time to be a little bit conservative on duration and largely be focused on the accrual oriented fund. And in that sense, I think low duration, sticks its neck out. I think that's one category where there is maximum traction in my view. And then you have the two adjacent categories, which is money market and short duration. So you can spread your wings a little bit in those two categories as well.
Sure. So if one has to summarize that, from low duration to short duration, these are a few categories that you see that, could make sense at this point in time for the fixed income investors.
That's right.
Sure. Thank you so much, sir, for the lovely insights for the month of October 2025 on the fixed income space.
Thank you, everyone. And I would like to end with wishing everyone a very happy Diwali.
Sure. Thank you, sir.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.